in just 1 month. So my question is, and I'm sure many of us have the same question, if there are existing systems, and in the case of UPI, actually government NPCI enabled, which work and which are working well, which are getting mass adoption from consumers, which have solved a lot of the problems we've articulated of friction, cost, efficiency, etc. Why reinvent the wheel? And especially in the case of an entity like Bank of Thailand, which is, or MAS in Singapore, which has pursued a very strategic, or even PBOC, probably you articulated the longest term vision that any central bank has had on this has been the People's Bank of China. So if this is part of a continuum and your existing measures and models and frameworks are already working, why reinvent the wheel? Do we have a very robust answer to this why? Lekha, starting with you, and then perhaps I would welcome all of you to kind of chime in and share your thoughts.
Yeah, as I was sharing about the initiatives that we have, the main strategic directions that the Bank of Thailand has is that we want to encourage the building of the open and interoperable infrastructure so that all the participants can leverage on the same infrastructure. So the RTGS is one of the examples, but as I said, it's actually there, and how can we do it with the better performance or the adoption of new technologies? So one of the conversations talking about having the operation 24/7, why not? RTGS is open now, it's only through working hour. So as mentioned earlier on Monday about the system that will do the same settlement windows across the RTGS systems, which comes up with our third phase of the internal project to collaborate with the Hong Kong Monetary Authority to link up our two, actually the proof of concept, to link up the project Internon in Thai baht system with the Lion Rock of Hong Kong dollars. So that's going to create another efficiency of the cross-border payment rail to be the real time and to have the real PVP settlement, payment versus payment, in addition to the DVP on the security markets. So besides the better operations that we can provide, another important thing is about how can you buy in the industry? Because you can't do it alone as being a central bank. You need the participating bank. And I can tell you that it's not cheap to do it. And one of the things that we want to encourage them that, okay, this is the learning space, we do it together, and you can explore and think about some other use cases. So this is basically the infrastructure. What can be very beneficial to even the wholesale or retail are the potential use cases that you can adopt on this infrastructure. So as I said, we've seen some of the developments that corporates want to have their own stable tokens to maybe like settlement within their companies, or even in other industries like security markets. So some people said that if central banks are not doing it, somebody else is going to get out and do it.
Thank you very much, and I think you've made a very important point right at the end. Goes back to what Professor Lee was saying earlier as well, in GV Trust versus in CV Trust. C stands for corporate, and if time permits, we'll probably very briefly touch upon Project Libra, because that is the elephant in the room. But let's try and take, I know there are a lot of questions, so let's try and take the audience questions. The first one I think we've just addressed now, that do we need blockchain for CBDC, or does a centralized system work better? And we just discussed this in a fair bit of detail. My key takeaway is interoperability, a more efficient settlement, payment, and since you mentioned Lekha, this pilot with HKMA, even cross-border flows, and similarly with Project Ubin and Project Jasper, MAS and Bank of Canada have done that as well. So it's already moving to a stage where it is going beyond national borders. So we've addressed that. Interesting. E-money is not tangible, and now we are taking it on an immutable ledger like blockchain. How can central bank ensure disputes are resolved and losses are recovered. Anybody? Marcello, Professor Lee, you want to take that?
Sure, possibly, sure. So, I think there are actually 2 points of view of these questions. The first one is, when there is e-money issued, what happens if the e-money issuers defaults? So what happens to my money? That is something that has to be taken into account. That is, you want to, when you have a liability, when you're holding e-money, you have a liability on the e-money issuer. So you want to make sure that this liability is actually worth something in terms of if something goes wrong in the economy. So there must be some sort of regulations put into place so that e-money issuers, they have enough liquid assets. So it's part of the whole strategy of trying to provide consumer protection to the people that use e-money. Another part of the question would be, okay, if there are disputes in terms of when we are changing something, if I'm not going to lose what I'm changing and so on. Well, clearly, this is also part of consumer protection. I think whenever we're talking about digital things, we need to make sure that there are in place enough checks for the economy to go forward, because the payment system is the basic foundational block of whatever we do in our economy. For whatever exchange, we always go to the foundation system. And that is why they are public good, and it is why sometimes, usually central banks, they are provided with the task of oversight and control of a payment system. So we always want to make sure that there are enough regulation, oversight in place so that there is no problem of security and safety from in terms of losses, but also in terms of cybersecurity, which is another elephant in the room that we didn't discuss too much about.
Thank you. And as you rightly said, there are, and most central banks around the world have pretty robust policies and their circulars on e-money licenses and how e-money issuers can make it more robust and more secure in consumer protection. So I think that's already built into the system. And going back to what Professor Lee and Marcello shared, if you follow this synthetic CBDC or DCEP kind of a model, then a lot of the front end would probably, to my sense, fall under the purview of the existing EMI license regimes and safeguards, etc. as well. Before we go to the next question, again, I want to flip it a little bit. And here I'm asking probably a slightly more personalized question from my 20 years as a banker. Any other bankers here in the room? Or everybody here is a central banker? Am I the only one who has had a background in banking? Nonetheless, I'll still be brave enough and field that question because I think it's important. So we've been talking about the holy trifecta for central banks, which is systemic stability, consumer protection, and efficient and robust payment systems as well. And here we are seeing CBDC solving for that in a way as well. We've heard the benefits to the consumer. We've heard about benefits in terms of cost saves, efficiency, transparency, interoperability, etc. as well. So I think checkbox all checked. The question is in all of this, and if we were to take it to the next level of a retail CBDC, while China is doing it with the the front-end players or the private sector players like wallets, etc. If this were to go to the next level, what happens to the commercial banks? What happens to institutional and systemic stability in the system? And going back to what you said, Marcello, if all these wallet providers, the M-Pesas of the world or the Alipays or the Paytms in India are now going to park their floats, not with commercial banks, but with central bank reserves, then it's a very fair question to ask already, and we were discussing it yesterday. Already banks are feeling the squeeze with fintechs first, then tech fins and all these large tech giants or FANGs, as we heard yesterday, they are nibbling away. Then we are talking about open banking, which is shrinking the space for banks to have some, if I may say, a closed system. And now we are talking about the possibility of CBDC and these large players who've already taken away the customer interactions from the banks, now also putting their floats with the central banks. So is that something which is a worry to both of you as central bankers here? What is the central bank's view on the other key pillar of this ecosystem? And I am not here to kind of put forward the bank's perspectives. I am simply asking a question from a systemic point of view that needs to be addressed. So Lekha and Sarat, and again, Marcello and Professor Lee, if you would like to add in as well.
Sure. Okay. in term in Cambodian case, if you look at the design structure of the Pakong system, it designed as two-tier system. One is at the central bank level, and another one is at the customer level. So the Pakong system will not success without the participation from the financial institution. So in order to make, we need to provide the value proposition to this institution to join with us. So the most value proposition is on the benefit. What are the benefits that we can give to them, when they join with us? So whether we allow them to charge the fee in these schemes or not? So to us, we cannot provide this as a free public good to the end user customer. That's why, because we need the participation from financial institution. But that's why at the end of the day, we allow financial institution to charge the fee to the end user. And another value proposition for them is that if they, like I mentioned earlier, if they join with us, they can access to a larger scale of the system. And also at the same time, they can access to the data that is stored in the Pakong core with us. So these are the three things that we try to talk to the participant to persuade them to join with our system. So the most important thing is on the value proposition that we can offer when introducing the system. So this, thank you.
Yeah, as I said, we cannot do it alone. We need the commercial banks to be in the picture for sure, because for us, we've done the wholesale one, and we are not expecting to hold individuals' accounts with us as a central bank. So the currency account, the reserve, is still based on the commercial bank's accounts. But speaking of the e-money service providers, who are also the new players in the market besides banks. So they're not acting as the deposit takers in our economy. They provide the means of payment that's moving more efficient, and as our colleague mentioned about the interoperability, that currently most of the those e-money service providers cannot connect the system together. But in the context of Thailand, we have a quite well-established fast payment system called PromptPay to be the infrastructure to connect all the players together, including banks and non-banks. So for us, the retail part will not have much of the problem, because we already have quite very useful and efficient PromptPay, which currently have 50 million IDs registered. So basically, you can transfer money from your account to your friend's account instantly across the bank on PromptPay. So via your mobile phone number or your citizen's ID. So I can get the tax return from the government really fast on PromptPay. Apart from that, and also we built the standardized QR code and that in the context of retail payment. So speaking of the wholesale, that's we explore on this. So and we think that there are a lot of opportunities to be waiting for to increase efficiency and also reduce the cost. And the commercial banks want to participate in.
Thank you very much, both of you. So my key takeaway from this is this will largely evolve as a two-tier system, whatever I've heard and gathered so far. There will be a role for the e-money providers who front-end and provide much better frictionless services to consumers. There will be a role for the banks as well. And in a lot of cases, like we heard for Thailand, probably countries will ride on their existing front-end architecture, and this will become additive rather than substitutive. Professor Lee, any thoughts?
Yeah, I think to answer that, it depends on what sort of banks you are. If you are a bank that focuses on bank tech rather than fintech, then you should be worried. I think the entire movement is moving towards the kind of problem we are trying to solve here. We have a major problem. We have 50% of people not connected to us through electronically. We have 70% of people underserved. So we are all here because we are trying to solve the problem. And if that problem is solved, then there's no interest in the digital currency that we are talking about, especially by central bank. So to answer that is that the central bank, when they issue this, they are trying to solve a lot of problems. I can only think about what China is doing, is trying to solve problems that existing they couldn't solve, which is the 50% not connected and 70% underserved in the region just right here that we're talking about. So it's important to think about all the features of the blockchain that can solve this. And blockchain is not trying to solve the production efficiency problem. It's about collaboration efficiency problem to ensure that anyone who is interested in serving the underserved are able to be on the platform. So that will require using smart contract, which is very different from digital contract, and in a blockchain system where you can have a centralized system where the M0 is tokenized, but at the second layer, with all the financial institutions, they can have a free hand to do the innovation. But with that come with a lot of risk. So in the traditional finance, we always talk about financial literacy, and that is not enough. It's more important now to know about fintech literacy, because in the finance world, we talk about how risky is a financial product, how complex it is, but seldom we talk about how risky is this app, how complex is this app, is this suitable for people who download this app? So I think China last week announced quite a few things. One is that the year before, they already started regulating blockchain companies. There are 500 companies in China which are regulated. They have to report to the regulators. And last week, they announced a cryptography law. So anyone will come out with any of the cryptography, which is very different, they will start regulating. And there's that. So the regulation framework to counter the fintech risk instead of financial risk they are talking has to be up one notch. And this is where fintech literacy become important, first of all, for the wholesale level, and then to the retail level. But we have a problem to solve. So you're only focusing on bank tech to make the bank more efficient. It's going to be very difficult because production efficiency has reached a level. The only way for you to increase your earnings is to leverage or make your financial product more complex. But if you're looking at fintech, inclusive fintech, then you're increasing the number of customers, which is underserved, and you are having new products, which we just heard from Mr. Hughes earlier on. We need to have the new financial products to serve the customer which are not in the financial system, economic system now. I think that is the problem that we try to serve, and that is why we have the central bank digital currencies, not just about saving monies on printing currency or minting coins. It's about using smart contract and all the advanced technology that's available to us. They won't be able to solve by the blockchain. It has to be convergence of technology with IoT, with AI, and with the rest to ensure that the risk is lowered, but at the same time for new regulation to come out so that we can do mass adoption. So this is my view of why are we having this new digital currency system and why are we embracing blockchain and other technology.
Thank you, Professor Lee, and as always, passionately articulated. Marcelo.
I just want to step in a little bit with this implication, because of course we have to think about, we're changing something that, especially in case of the retail CBDC, would really be a paradigm shift of how money is handled in the economy and so on. So we need really to think carefully about the implications, the micro and the macro implications. So the micro implication, we have to think about consumer protection, AML, anti-money laundering, integrity of the payment system, all these things that have to be really, really thought through before one actually steps in. But then also there are the macro implications. As Malek was actually saying before, what's going to happen with the banking system? So the banking system now in many countries, probably a little bit less actually in the Asian countries, is the fundamental provider of means of payments. Are they going to be taken away, disintermediated? Are people going to actually take their money and deposit away from banks and put it into a CBDC? So these are clearly important questions because they affect what banks do now, what are the sorts of finance, and what actually, if they can perform that in the future. Banks actually provide credit, which is a usual thing in the economy. So there are implications for that, and we need to think them through clearly. A lot of them, a careful design of the central bank digital currency can mitigate some of the implications. in terms of being interest-bearing or not? Are you going to be, is it more similar to cash, so there's no interest on cash? Or is more similar like a deposit? Actually, there is interest paid. So all these choices are there in order to try to, for us to design something that actually is going to limit the risk in the economy. And something else, where I think yesterday morning in the first panel, Heidi from Standard Chartered Bank was saying, 5 years ago, people were telling me that my job in 5 years was going to be away because all the fintech, they're going to take them back. Well, it's been 5 years. She still has a job, and we're happy for that. And banks still exist. But what we're seeing is also sort of collaborations between banks and fintech. So it's not, there can be consequences for banks, but we should not expect banks to sit idly and do nothing. Cooperation can happen. And while though we need to think really through the consequences, the financial stability consequences of introducing a central bank digital currency.
Thank you very much, and these were some great points made here. So my key distillations and takeaways: one, design thinking becomes very important, and Professor Lee articulated it in his workshop as well. So we heard it from Sarat as well. So Lizette, perhaps one learning for us, and maybe I'm already giving you ideas for next year, is maybe we should have a CBDC design workshop, because all of these elements are important to consider in terms of the way you're going to structure it, interest-bearing, non-interest-bearing, as a monetary tool, in terms of how do you manage inflation, etc. So the existing tool set of central banks, how this can either augment, maybe slightly substitute, or completely replace. So that whole design process is going to be important. Two, keep the objectives in mind very, very clearly, and put your national framework, and then align it. There's no one size fits all. I think we've heard that message loud and clear. Three, as Professor Lee and others articulated, this will be an evolutionary process and a journey. It will not, you cannot go by the fads which are there in the marketplace, etc. And as he said, you also have to bear in mind there are a couple of questions which ask about why DLT, why blockchain. Are we just confusing or complicating, or just creating more jargons and hype? It boils down to the design aspect of it, and the fact that there is a role for production efficiency, and there is the role and a need for collaboration efficiency, as Professor Lee said. So be very clear why you want to use it, and we heard about interoperability as a big evolving challenge, and maybe the next phase for central banks. So think of it in terms of collaboration efficiency. This is, as we all know, this is not necessarily the most efficient production tool, but it's the most efficient collaboration tool. So, when you talk about it or explore it, think of it in that context. And as we've seen with the example of Project Inthenon, collaboration efficiency can actually transcend national borders as well. It could become a cross-border framework, and perhaps if we were to end on that note, even an ASEAN kind of a framework. So that could be our big picture vision. And the last thing, Lizette, perhaps again a suggestion for us for next year, maybe we should have a topic not just on financial literacy, but fintech literacy, because the tech is becoming more and more important, and we heard it from Nick earlier as well. We have to super simplify it for the end consumers. I would have loved to go on, and I know there are many questions. Hopefully we try to address as many of them as possible in the most simplistic and logical and rational manner. So you did get some food for thought, if not answers to all your questions. On that note, please join me in sincerely thanking all my 4 fabulous panelists. They did a great job of articulating it from different perspectives. Thank you very much.
And please give a big hand to our moderator, Maritan Rabia. So, our next session will be on cybersecurity, but we have first to secure your calorie intake. So we're going to have a coffee break, and we have 15 minutes buffer time, so we're going to have our full 30-minute coffee break. We're going to continue quarter past. Awesome. Enjoy your coffee and have some snacks, and see you in 30 minutes from now back here. Thank you very much.